Since the COVID-driven market crisis last year, credit markets have been a key area of focus for investors. However, the fast retracement in spreads has given some investors pause. In certain cases, credit spreads are now inside their pre-COVID levels. But even with a potentially tight beta situation, we believe attractive alpha opportunities exist today for long-short credit strategies. This is driven by three main reasons. First, tight aggregate spreads are not necessarily a precursor to low alpha. Broadly speaking, managers of absolute return-oriented strategies typically prefer higher levels of market dispersion. This is due to the potential for bottom-up idiosyncratic opportunities. Managers are generally not concerned with top-down calls on beta. And 2021 has shown that there remains a healthy amount of issuer-level dispersion and dislocation in the market. Let me offer one data point that may help drive this point home. In the first quarter of 2021, $900 billion of U.S. corporate bonds had a quarterly excess return that was at least one standard deviation above or below the market return. That compares to an average quarterly figure of $700 billion historically. In other words, we've seen no deterioration in issuer-level dispersion. Second, the fundamental financial picture is mixed across credit. Corporate leverage remains elevated, but it has been balanced by better revenue and earnings figures. Meanwhile, M&A activity, which is typically negative for bondholders, has been increasing, while issuer upgrades have been outpacing downgrades. We believe these mixed messages suggest that the market will continue to focus on the financial details, weeding out good credits from bad, and potentially creating an attractive environment for fundamentally oriented credit strategies. Lastly, the market remains structurally vulnerable to systemic shocks. We have all heard this story. The street is no longer an active liquidity supplier in the bond market for regulatory reasons. At the same time, the demand for liquidity has grown exponentially. Think ETFs, life insurers, and so on. As a result, market-moving events such as COVID have an inordinate effect on the functioning of credit markets. As you may recall, in March of 2020, we saw a massive 5x move higher in the bid-ask spread on investment-grade credit and the corresponding illiquidity measures. These types of shocks can create panic, and they're happening at an increasing frequency. Yet, each time, they also present enormous opportunity to be a liquidity provider for a price to a stretched one-way market. That's something that long-short credit strategies may be able to take advantage of. In this environment, I believe long-short credit can potentially be an alternative alpha source in a well-constructed portfolio. It may also offer the diversifying attributes that may be associated with these absolute return-oriented strategies. You can read my paper for more on this topic and let us know what you think. Thank you.